Good afternoon. Hello, everyone. Thanks for joining us for this month's Impact PHL Conversations focused on employee ownership as an alternative to extractive private equity capital. My name is Corey Donovan. I'm the co-founder of Impact PHL. We are an impact investing advocacy organization here in the Philadelphia region and community builder. I'm pretty interested in this topic. It's something that's a high priority to me, and I think should be a high priority for anybody who cares about local business, cares about local communities. And we have two national thought leaders on the topic. So I'm really looking forward to it, and I think you'll find it pretty interesting. A couple of housekeeping items before we continue. First and foremost, I want to thank our funders. We literally couldn't do this work without them, and they really buy into our work and fund us over multiple years. So again, appreciate all the logos and names on this slide here. Also want to alert you to some upcoming events that we have. Total Impact Summit is coming up next month, so we won't have an Impact PHL Impact PHL Conversations in May, but encourage you to check out Total Impact Summit. You can use code ECO26 to save $600 off the ticket price. And in June, we'll be highlighting Invest for Better. The first national chapter was here in Philadelphia, and so I think it's been over a year now. So we'll have them talk about what they're doing and how things are going, and I think it's well over 100 women now that have participated in various cohorts. So looking forward to an update there. We are recording this session, so it'll be available by the end of next week on our website. You'll get an email if you're registered for this event that it's available. So if you want to share it to anybody else, if you hear anything that is insightful, you think someone else should hear, you can forward the video out to other folks who need to hear it, whether they be peers or board members, etc. Put your questions in the chat. We'll be monitoring that, and Craig, as the moderator here, who I'll hand things over to, to get your questions. So we'll take input that way. And with that, I'll hand things over to Craig to get us kicked off. Thanks again for joining us. Craig?
Great. Good afternoon, everybody, and thanks for joining us. I'm excited to have this conversation with Brian and Allison, and we're not going to waste time on bios. So we're going to kick off by asking Brian and Allison to talk a bit about their organizations, and then we'll jump in. So Allison, if you don't mind, would love to hear more about Ownership Capital Lab and sort of where you see yourself fitting in the ecosystem of employee ownership.
Sure. Yeah. Well, thank you so much for hosting this conversation today. Just absolutely thrilled to be participating. So I'm the founder of Ownership Capital Lab, and I've been in the employee ownership space now for nearly 15 years now, previously as co-founder of Project Equity. And I really have come to believe that it is the growth of investment capital that is our biggest and sort of most unattended to scale lever within employee ownership. And that's what Ownership Capital Lab is set up to do. You can think of us as a financial backbone within the investing capital marketplace to grow this particular form of impact investing, which is employee ownership.
Hey, I'm Brian Boland with Delta Fund, which is a name for the work that my wife and I do as essentially wealth holder activists. We look at investing our assets and capital in ways that build an economy that works for everybody. We firmly believe that the economy today doesn't. And so one of the biggest levers that we see is around ownership and voice, wealth building through the ownership of businesses in place, voice through the ownership and control of those businesses and places. And we think about these conversations as transforming the way that other people think about where they can be investing their money to build a society that works better for themselves and the people around them. And so that's one of the things we're really excited about with this topic.
Great. Thanks, Brian. I'll throw the first question to you. What makes employee ownership a meaningful way to build wealth in communities like Philadelphia is the first? And then tied to that, as more local business owners are looking to transition or sell, what's at stake for the businesses and the communities in terms of who actually provides the capital for that transition?
Yeah, I mean, there's a lot in there, and it's such an interesting topic. If you think about, this trend that we've been on the last 50 years, where there's been this shift towards investor primacy and shareholder primacy, and that the idea that the investors should make the lion's share of returns over anything that they're that they're funding. We haven't always thought that way. We used to think about businesses as having a role in our society and businesses as having a role in our communities. And the opportunity to look at these businesses that have existed for a number of years and are successful. These are not kind of like startup ideas, which I'm a fan of, startups, anyways. But these are businesses that are working. They're important fabric of their communities. And now there's an opportunity to say, well, how can the employees participate in this? And how can employees not necessarily have to sell the business to end up with a better outcome, but by owning the business, they participate in the revenues and the profits of the business. And so you can have better wages. The owners of the business as employees can decide on the benefits that are important to them all, and they can improve their benefits. And so those two pieces of wages and benefits are direct benefits of owning that business, whether you end up selling it ever or not, right? It changes the calculus of who is making the decisions and whose voice matters at the table. And when you think about investors, there's such an opportunity to me that goes a little bit beyond just the numbers on the page. When you think about investing in businesses in your area or in your community that you are keeping in your area or in your community. You're keeping them from going out of business if the business owner is looking to retire. You have something that is stable. A lot of the research that people don't talk about is the stability of employee-owned businesses. So, as an investment standpoint, people fear that these are going to be risky, high-risk investments, and they're just not. And so, the opportunity to invest your capital in ways that build again as opposed to ways that speculate and roll the dice at a casino. You're actually changing what happens in your community by investing in that growing fabric of your community.
Great. And I'd like to sort of follow up later on in the conversation about your comment on investments in risk for all the advisors, investors in the phone. But Allison, would sort of throw that to you. Why is this important, and what's at stake as you look at these small businesses that form the backbone of the local communities?
Yeah, well, I'd love to build on what Brian was saying about, the capital being controlling so much of our economy, and just share a couple of things around how financialization of our economy is showing up to give, this sort of super macro perspective, which we know that, financialization of all things are in our economies is bad for the local economy, the local community, for workers, for families, right? But just a couple of things that both of these blew my mind when I heard them. One is that when you look at the food commodity businesses, like the massive players that are, moving the wheat and the soy and the corn all around the world, these companies now actually make more money off of betting on what the future price of those commodities will be than they make on moving the food to the people who are going to eat it, right? So they're betting on what the price of wheat is going to be next week, right? And that drives their bottom line more than feeding people. Second is airlines. So airlines apparently mostly make more money off their credit card products than they do from moving people from point A to point B. Right, so we have these massive jets, right, with huge amounts of jet fuel being used that are basically, think of them as credit card acquisition and retention strategies, right? So that's what's happening in the macro economy. And then so now we take that and we apply it to our local businesses and our local economies. You drive to anywhere USA and you're going to see the same brands, right? Whether it's coffee or electronics or retail or whatever it is. And, we're in the middle of this historic business transition. Nearly 3 million companies are owned by people at or near retirement age. And so those businesses are going to change hands or quietly close down. And, in Pennsylvania, there's north of 100,000 businesses that need to find buyers as baby boomers retire. And now we compare that to sort of the current number of employee-owned businesses across Pennsylvania, which is, something like 300 to 350, like 300 to 350 compared to 100,000 businesses that are in play. And so this is the gap and the opportunity that we have. The employee-owned businesses, we're talking about changing people's lives and their future family trajectory, addressing intergenerational poverty, stabilizing businesses in our local economy, and actually preserving the kind of local economy that we know people prefer and really like, and that makes communities thrive.
Thanks for that. So, my own personal experience with employee ownership is what I would describe as frustrating. About 10 years ago, I co-founded an asset management firm with two other partners, and it was our intent to actually structure the firm so that the employees we were hiring up, there was a natural progression and a way to transfer ownership as we sort of matured out and went on to whatever was next in our chapters. And we spent a year and some significant financial capital doing research, and we kind of scratched our heads and said, well, we don't know what we don't know. Of course, at that time, we didn't know you all. So I guess as someone who's been through there and spent some time and resources and was unhappy with the result, what's the difference between real employee ownership models that offer sort of true ownership and those that offer some financial upside without giving them the longer term connection and link to the profitability of the organization financially?
So much in there. It was such an interesting question. And like your journey, that's not an atypical journey. Like, the easiest thing to do is to just be a dictator, to take all the profits and sell it to the next dictator. That's just way easier to accomplish in the world and way worse for society. So it's a harder road to go down. And I think there's a couple of aspects of one, your journey of trying to say who's helping me figure out where to go and what options we have. There's now a growing number of firms like Project Equity or Common Trust or ICA Group who can help you navigate those questions of what's the right suitability and what fits. That hasn't existed until the last decade or so. And so we also need more ways that companies can build in ownership into their plans and their models. Recently worked with a company, was a part of their Series A, and they were planning on adopting the employee ownership trust model. But then when they looked into the details, it didn't make sense for the type of financial business that they're building. And so they actually did a whole bunch of work to create a new model that really fits for their purpose. And so, that's an example of needing to be creative and innovative and build a structure that rewards and turns the business over to employees over time. I think right now we're at this interesting juncture where I think people realize that the economy for most working class Americans isn't working for them. And so there's an opportunity to give people an out, and that out is through employee ownership. Now, there's some other folks in the investment side who recognize that, and they're preying on the feeling that people might feel like they're an owner. And they talk about the language of getting people to feel like they're an owner, but giving them a small bonus if the business sells. It's usually private equity who's doing this model. It's a short-term equity plan. It's really a bonus plan. And I think, to me, the lines that are important to draw is meaningful amounts of ownership. We've kind of learned from others that 30% seems to be like the meaningful entry point for employee ownership levels that matter for a business to really take care of its employees. That how you think about representing the employee's voice. So, if you have a company that's not 100% employee owned, you can still have employees have a seat on the board or two seats on the board, or they can have very meaningful roles in governance of the company. And that is important in creating that voice. A lot of these kind of fake private equity models are really just preying on this moment and this movement, and I think doing a disservice to this work.
So let me sort of dig a little bit deeper on that, then Allison, I'll hand it over to you. What's more complicated for the small business owner, the governance piece, the power, right, the agency piece, or is it the valuation piece? And sort of, I'd love to hear maybe a case study or two, or like an example of where those have come together well, and maybe where they haven't.
Yeah, I'll give you a quick one, and then Allison's got, I'm sure, a litany of them. But back to that company that I was telling you about that kind of solved their employee ownership through the structuring. Part of that was the valuation of the company, which you want to have something that's defensible. And part of what makes ESOPs particularly strong in their framework is that they have good valuation methodologies behind them and protections around that valuations. Things like employee ownership trusts don't have as much legislation and regulation behind them on the valuation side. So I think that's an open question. But on the governance side, the company I was telling you about has one of the seats on the board is run by the employee ownership trust, and over time, as that trust grows, it'll be two seats on the board. And so it really kind of creates a governance structure that transitions over time that I think has worked quite nicely for that business.
Thanks.
Yeah, and I can jump in and say that I'll often talk about the three legs of the employee ownership stool. Two are financial, and one is about voice and control. And for every employee-owned company, you need to be looking at, what are those, how are you designing around those three legs, right? So the first one is money in people's pockets today. So that's profit sharing, that's better wages, better benefits, right? And so if you think about from a workforce perspective, what matters to your workforce, if you're talking about a company that's primarily frontline workers, money in people's pocket today matters, right?
Mhm.
The second is the long-term asset building. So the ability to, accumulate that wealth and have it grow over time. And that can be accomplished through a variety of ways. And the different forms of broad-based employee ownership may do it differently. And then the third is voice and control. And so are we talking about developing a participatory culture where you're training all the managers and you're having people really, truly have a sense of ownership over their sphere of influence in their day to day? And then are you talking about governance level role where you have as Brian was talking about, seat or majority control of the board of directors? And so when we think about, the context of what we were just talking about, the changes at the macro level of our economy, and we're trying to create something different that protects the small businesses and enables our local economies to thrive in a really different way. We're talking about wanting to have those all three legs of those stools of that stool be addressed, right? So can workers build real wealth? Or do the workers have a real voice in what's happening to the business? Decisions that are affecting their lives, their families' lives, the broader community? Is the structure built to last? Right. And so if you want to tie it back up to the macro, right, is this ownership going to shift the balance between the big capital holders, the financialization of our economy, right? Is it fundamentally something different?
Okay. Allison, I'm sure the answer is it depends, but I'm going to ask you the question anyway. Where does Ownership Capital Lab sort of like, where do you come into work directly with the companies, with the business owners, with the employees? Like, I'm just trying to help everyone understand, sort of given all the pieces that are being moved around in these sorts of engagements and the complexity, like where do you sort of fit in, and like where's the easiest place for you to sort of support the small business owner in their journeys?
Yeah. Yeah, well, in my current role at Ownership Capital Lab, we actually don't do the direct hands-on work supporting the companies through that transaction. And what we do is we support all of the funds in the space, and uh, there's about between 25 and 30 employee owner, 29 at our last count, of employee ownership funds in the space, specialized funds that are raising capital to finance the transition of companies to employee ownership. And so those entities are going to either they themselves through their team or partnering with other organizations will do that direct hands-on work with the business owner. But one of the distinctions that I really want to make clear is, your experience, Craig. You were talking about, oh, I'm a business owner. I'm not really sure how to go about doing this. And so,
Mhm.
sounds like you really needed an employee ownership consultant to help you with
Mhm.
that. And there's, as Brian was saying, a number of really great organizations doing that work. Um, what we've seen in the past, say, 7, 8 years is the growth of the approach of funds that are raising capital in order to compete in the M&A marketplace. So not in the consultant marketplace. Like we have 50 plus years of history of employee ownership happening through the consulting route. And that's really important part of the work and it needs to continue going, right? That's how we have, roughly 7,000 employee owned companies in the United States today.
And
But
Allison, just to be clear, so that would be consultants that focus on employee ownership, not investment consultants that are working with investors, foundations, and endowments
correct,
to actually build a
correct,
portfolio. Okay, just wanted to
correct.
have some
Yep,
clarity there.
yep.
Okay, thanks.
But in the M&A marketplace, there's somewhere between 7 and 10,000 transactions that happen every year, right? So this is where the companies are being bought and sold. So 7 to 10,000, and we have between 5 and 600 employee ownership transactions. So the shift that we've seen is folks raising capital to show up in that marketplace as acquirers and the ability to tap the business owners directly. They could have come to you, Greg, and said, hey, we want to acquire your company, and we're going to do it through employee ownership. They're often competing in competitive bids, that are being structured by their advisors or their investment bank or whatever it is. They're competing in competitive bids, and they report that they typically win those bids. Now, why do they win those bids? They win them because they're financially competitive to the mainstream, usually private equity offer, but they have the cherry on top of the employee ownership, which means that I, as a business owner, am going to be able to walk around with my head held high in my community, knowing that the transition that this company is not going to be sort of stripped for parts or, right? It's actually deepening its impact in my community, my local economy. So, we have sub $1 billion today in those funds. It's a nascent marketplace, and the ability to really grow that sub 1 billion to 10 billion, 100 billion, in the context of $11 trillion private capital markets. Like, that's what we're talking about. This is the opportunity for investors to really lean in and say, hey, what outcomes do I want? Do I want the outcomes of the mainstream market? Or do I want the kinds of outcomes that we're talking about with employee ownership, where frontline workers, and this is from my own firsthand experience, frontline workers who become owners of their businesses are seeing just a completely different financial perspective on their lives, right? The ability to breathe financially, the ability to actually have a nest egg and an asset, the ability to become a homeowner as a co-owner of a bakery or a cleaning company. Like, these are real stories from my own experience. And that's the kind of life-changing impact we're talking about, while preserving these local businesses that, are sometimes multi-generational within a community. And then when they sell out to an sort of out of area buyer, things can just change dramatically.
Okay. Just to sort of dig a little bit deeper, when you look at the universe of funds that's available, like what's the biggest challenge that a lot of these funds are sort of pushing up against? I assume one of them is introductions to the sort of intermediary space and the investment consultants, those that actually control the flow of capital. But like outside of that, like what's the need, and what would go to make these funds and fundraising more effective from your
Yeah.
perspective?
Yeah, well, and Brian has a ton of perspective on this question as well, but let me just jump in briefly, which is,
Okay.
most of these are emerging fund managers, at least from the perspective of an institutional investor. We have, two fund twos that are sort of in the market rate part of the market. So an institutional investor is not going to look at a fund manager until they're, maybe fourth fund, sometimes fund three. So the fact that it's a nascent investment marketplace is a challenge for these funds. So the need for investors who believe in the mission and want the outcomes of employee ownership to come in and put their capital behind them is absolutely critically important. And then second, I will say, just, overall, the familiarity with employee ownership is low. So, the need to be able to bring this as a, yes, an impact strategy, but also a risk adjusted return strategy, is incredibly important. And we can talk about, risk in employee ownership and get into some of the details on that. But let me turn over to Brian to share your
Great.
perspective.
Thanks.
Yeah, look, I think a lot of the investor side has gotten really comfortable at the last couple of decades of growth of the free money era where things were just really easy. And so when they look at some of these deals, they're making the mistake of not wanting to put in the time or effort to understand a new lens of thinking about investing in ownership like we invest in infrastructure. And then I think I see a mistake where investors try to figure out what the benchmark comparable is for these types of funds, and they invariably pick something higher risk so they can either say no or get or push for higher returns on the kinds of funds and deals that are being built. And I think a lot of the investors that I've seen move successfully into the space and enthusiastically are recognizing a couple of things. One, as Allison referenced, the risk-adjusted return side of things is actually incredibly favorable for the capital that investors put in. Two, there's a reconnection of purpose for capital, not just capital for capital. And I think that sense of the capital doing something, the same way that you get excited about building green infrastructure and building renewables, you're building a different kind of infrastructure for our nation, that's incredibly powerful. And so those are kinds of some of the things that I see are missing. A lot of our, the larger investors are so complacent, so unbelievably complacent in how they've been investing, that I'm really eager to see the challenges of the economy moving forward because it's going to force them to think and do things differently. If anyone thinks that the markets are going to continue the way they've continued in the free money era, or continue in the way that they could continue in the AI disruption era, they're kidding themselves. And so now it's a time to say, like, what are the things that are going to be persistent, that are going to grow, that we need in our nation? The kinds of businesses that are manufacturing through to lawn care companies, all these different businesses in between are incredibly powerful forces for our nation that are something that investors need to be much more aggressive about enthusiastically pursuing and redefining their models on risk and return.
Yeah, and
Great.
just to give a couple of data points behind what Brian is saying, there was a study done by the National Center for Employee Ownership that looked at the default rate of loans from banks to ESOPs, which is the largest type of broad-based employee ownership in the United States. And the time period that it covered was included the Great Recession. So this would be a time period where you might expect default rates to be higher, right? So the annual default rate for this group of, it was a big sample size, was under 0.3% annually, right? Which is roughly about 10 times less than the typical small business loan default rate. So, when we think about risk adjusted return, and especially when we think about what's happening right now in, these are mostly in the sort of quote unquote market rate funds. These are private credit funds. And, there's a lot of volatility right now in private credit, and, there's lots of questions being asked. And these are funds that are not only transitioning to employee ownership like we're talking about, but are actually playing a role of the sponsor, like what the private equity role might be, by often
Mhm.
taking a seat or a couple of seats on the board of those businesses. So they're hands-on with the business to support its success. They are delivering on the combination of structure and ownership culture, which is, we know, kind of where the magic happens, that having a true ownership culture combined with actual ownership with the business is where we get the outsized financial returns for the businesses. And then for the ones that are leveraging the ESOP model, they also are able to tap into what is an incredible set of tax benefits that have existed since the 70s, thanks to Congress. The Congress is a huge supporter of employee ownership even today. And so this combination really sets this strategy apart within the private credit markets in a way that can be, very, especially in today's sort of volatility of private credit, very appealing for investors.
Great, Allison. You mentioned culture. That's something I think a lot about in terms of interactions with foundations, investment consultants, boards, and just really ensuring that everyone's marching the same direction for the right general reason. Like, I'm curious, when you look at a small business owner, like let's even talk about the funds that you work with, like what are the signs of a strong culture that is developing the fund, that is raising the capital, support the organization's long term, as opposed to we're looking to turn this over 8 years out for a 17% IRR, move on to fund eight. And I realize that there's a lot of ground between there, but just
Yeah.
since you call out culture, would just love to get your specific thoughts on that.
Yeah, absolutely. And if I were investing my own capital into the employee ownership space, I would look for the funds that are investing in building the ownership culture, not the fund building the culture, but supporting the companies, their portfolio companies, to build their own muscle to grow the employee ownership culture and support its, it's the fostering that culture over time. And as I may have mentioned, some of the funds are building that capability in-house to do that really well within their own teams, and some of them are partnering with strong external partners and bringing them in on a deal by deal basis in order to do that ownership culture work. But we talked about the governance role for workers, or inviting workers to participate in the strategic decisions of the business. Well, it's not really fair to say to somebody, hey, we'd like your opinion on, this year's business plan, unless you're really providing the scaffolding and the structure to help folks, understand what that looks like. And just a quick story, I was on a panel with the CEO of Sky Blue Builders. They're in the Denver area, and they transitioned to employee ownership. And he said, we were doing our annual planning, and we put out, a number in terms of the revenue growth we wanted to hit, and then we took it to the employee team for feedback, and the feedback was like, really, is that all? The team said, well, we can beat that, and we want to see a higher revenue growth this year because we know it affects us in our pockets, right? So, that's where you see that feedback cycle happening between the employee ownership culture and the outsized performance of these employee-owned companies.
Great. Brian, any thoughts on that?
No, I mean, I think that's a good story. I think it's great.
Okay, great. Want to sort of pivot a little bit. So I'm based in Seattle, and I know in Washington State we've had some fits and starts as it relates to policy to support employee ownership. So first question, what trends, if any, have you seen at a sort of state policy level? And then second, would love just to get your perspective on the rural versus urban divide. I know a lot of the same issues here, but a lot of the projects that I've done have focused on rural economic development. And so I'm just curious to where you can sort of take the trends that you're seeing in urban centers like Philadelphia and maybe extrapolate them to different parts of the country where other investors that are participating may be a bit more closely aligned with the place focused of the where the companies actually operate.
Yeah, I think we've actually been on a generally positive policy trend. So we've seen some really great wins at the federal level and at the state level with increasing support around employee ownership. Washington State has a bill on the books that's unfunded. That's a really good bill. We had some issues with the last budgeting cycle that we'll work our way through, but at least it's still in the books, so we'll get it back. So I'd say the policy trend is good, and there's actually some really interesting federal legislation that is being circulated this year. It's the AORA. I can't remember what it stands for, but I'm sure Allison knows. But it's a really good structure around building out even greater federal support for these types of transitions to employee ownership and removing some of the frictions that we've seen in the past. There are some good lending programs that put incredible onus on individuals to have to personally guarantee loans that they're impossible to guarantee individually when you're part of a large collective of employees. So there's some structural changes that need to happen, and I think getting people to advocate for those is going to be important. So good policy work, growing policy work, and we're going to need more voices championing that with your legislators. The good news, though, is that these are all bipartisanly popular. Turns out both parties like businesses and both parties like employees to own those businesses. So it's actually a win across the board, which is great. So that's a positive. When we think about kind of rural versus cities, we definitely see great approaches showing up on both fronts, very different approaches, but also increasingly necessary in our rural communities that we have these same kinds of funds availability and infrastructure support to be able to make these transitions. And so some of the state centers for employee ownership, I think, are providing support both in cities and across the state. The Washington Center for Employee Ownership is holding town halls and sessions in communities all across Washington to get the companies that are in the heart of Seattle and the companies that are in the outskirts of Spokane to learn about what they can be doing around employee ownership and then encouraging the growth there. When we think about funders and investors, I think the ability to have a place-based strategy where you can deploy a meaningful amount of capital in incredibly high leveraged, impactful ways is still underlooked from folks who care about place. If you think about what you could do, not just by investing in these funds, but for a foundation or for a wealthy family that could offer a guarantee against the loans that you could put into these business transitions. We already know from what Allison shared that the default rates are incredibly low. Guaranteeing incredibly low default rates in a loan is incredibly impactful because the people who don't want to reconcile the truth of the risk might be motivated by a guarantee that provides that backstop. So incredibly powerful ways for foundations and individuals to build place-based strategies. I'm hoping in the next couple of years you see your first kind of $20 million in a city fund that is just dedicated towards transitions in that city or that state. It'd be awesome if Philadelphia was that city. We've got a lot of friends who are great proponents of employee ownership in the region, and so something like that I think would be really interesting place-based strategy.
Right. Quick question, and then I want to sort of pivot, and we're getting a couple questions from some of the attendees, so I want to make space for that. You mentioned loan guarantees. So like makes me think about sort of overall, like what type of funding and support are most necessary to first build the ecosystem, but second, to continue to provide opportunities for funds that have viable investment theses to get introduced to the intermediaries, the advisors, consultants, that even though they have client interest, may not be working for organizations where the models and the way they actually approve investments are suitable for, a PRI $2 million loan guarantee for one foundation. So a lot there, but just curious, like what type of capital and what advice would you have for both investors and advisors that want to get smarter about employee ownership?
Yeah. Well, I'd say every type of capital has a role to grow employee ownership. So it's not, oh, which one? It's how do I what capital do I have? And then how can I use that capital to grow, to change the face of ownership in our communities, right? Um, so, certainly philanthropic capital has an incredibly important role. There are organizations, some of which Brian mentioned, that are nonprofits that are doing this hands-on technical assistance support. There's these employee ownership centers in Pennsylvania. We have the Pennsylvania Center for Employee Ownership. There's also uh, uh, the Philadelphia Area Cooperative Association, I think they're called, that supports cooperatives of all types. Um, so, there's a lot of the hands-on work that's happening in communities to support business owners and others learning about these models and transitioning. There's also a whole layer of field building and kind of infrastructure that's needed in the space. And, whether that's uh, you know, broadly increasing the awareness of employee ownership for specific audiences, whether that is building literally some of the infrastructure to enable the business succession and the capital markets to grow and expand. And then, Brian was mentioning guarantees. So the personal guarantee issue, you have a 50-person company. Who's the one person who's going to sign the personal guarantee? In certain parts of the market, and this is especially true for the non-ESOP form of employee ownership, so worker cooperatives, employee ownership trusts, that are of a size where they're not getting loans out of kind of the commercial arm of the bank. That personal guarantee is a requirement. And so being able to have, we're actually looking right now at Ownership Capital Lab. Is there a field-wide solution that could be built to raise capital from private investors in order to provide this guarantee, that could be hugely impactful to opening up capital in that part of the market? And then, investment capital, if you are an impact first investor, there's catalytic investment opportunities. There's, sort of more market rate investment opportunities, as we were talking about. So really all of it is needed. And one more point, which is that the current, I mentioned there's 29 funds as of last count in the employee ownership space. A good portion of those funds exist because philanthropy came in and helped with some of the costs to get them, underway and off the ground. And so there's definitely a role, for philanthropy to help foster the continued development of the new emerging market managers coming up from behind in this space.
Yeah, and I'd say Allison is absolutely one of the five best people in the United States on employee ownership and how to build these tools and systems. She spent 10 years building Project Equity. And the reason that she shifted from Project Equity to Ownership Capital Lab is because they saw some incredible success of the consulting and support services and helping businesses to be able to figure out which kind of model would work for them and how to model it out and how to actually get the coaching and do the transitions. And then she looked at the gap in financing. And the biggest lever that exists right now is that we have a lot of capital sitting on the sidelines at one of the most critical times in history. Allison taught me a few years ago about the silver tsunami, the fact that we have a generation of business creators and business owners who are looking to retire. And once they retire, those businesses might be gone forever if they don't sell to their employees. And so we have this incredible generational opportunity. And the work that Allison's doing now is tackling the financing question of where can we get capital systems to move differently across all dimensions to support this work that our grandkids are going to be thankful that we did. And so I would follow the work that Ownership Capital Lab's doing. Their newsletter and any of the information and events that they're doing are going to be great resources for understanding what they're seeing and what's growing and what's working. Because it really is necessary that we start to get aggressive in investing in our society again. And that's the core of this work.
Great. Appreciate that.
Thanks.
So let's take a few questions and there'll be time to sort of wrap things up at the end and let's get into the weeds a little bit. One of the questions is, can you comment on the size of the company and what ownership or cooperative models might be a fit for various types of organizations?
Yeah. So three main forms of broad-based employee ownership, and by no means cover 100% of the options of how to do this. Brian was talking about some of the innovation that's happening in the space right now, but they are the ESOP, Employee Stock Ownership Plan, which is, there's roughly 6,300 ESOPs in the United States as of last count, and this is the one that has the most federal tax benefits. And that's a big reason why there's the largest number represented. And, roughly, I see Michael Golden's comment, going below 20 for an ESOP, definitely not. I would say 40 or 50 employees is a good threshold. It depends, right? But general rule of thumb, 40 or 50 employees and above, because the regulation has costs and the lines kind of cross at that point alongside some other regulatory considerations. The second largest form is worker co-ops, roughly 1,300 worker co-ops in the United States. And so these are businesses that are owned and governed by and for the benefit of their worker owners. So they have the democratic governance built right into the structure, but there's nothing to say you can't build that democratic governance into the other structures as well. It just is an absolute requirement for a worker co-op. So companies of any size, most startups in the United States in the employee ownership space form as worker co-ops. For transitions of existing companies, I generally would say below 10 is really challenging. 15 or maybe even 20 business owners, 15 or maybe 20 employees is a good threshold size for transitions. And then the newest form in the United States, and at last count we had about 50 EOTs or employee ownership trusts in the United States, but well established in Europe, the dominant form there. And this is also a trust structure, and it actually uses what's called a perpetual purpose trust as the trust. So business owners that are really interested in the perpetual nature of that ownership are more likely to choose an EOT or a worker co-op. It also enables business owners to very easily integrate, if there's a sort of a third bottom line, if you will, or a climate mission or an environmental mission to integrate that into the purpose as well.
Great. Thanks. You mentioned, I'm looking at the questions, and there's a specific question about changing the name of employee ownership trust. And to me, like that points to language, right? An issue that Impact and Mission Line investors have been dealing with for over 20 years at least. And so I'm curious, like acknowledging a specific question about EOTs, like what advice would you have for investors that to keep them focused on the issue and the problem they're trying to solve rather than getting wrapped up into what bucket or what sleeve or what you call the sort of work that you're doing. And I know that there's no perfect answer, but as someone who's well versed in the language, like would just love to get your thoughts from both of you if you don't mind.
Yeah, do you want to kick off, Brian?
I'm still processing. I mean, look, like there's the problem that we have is that a lot of investors have very rigid spreadsheets that they are bucketing their investments into,
Yep.
and they're looking for which bucket to map these things into. And in some ways, that's like a good model because it's worked in the past. And that kind of goes back to some of my earlier comments. And then I think investors need to wake up and start to realize that the world has changed and is changing. And we need to start looking at different buckets and different sleeves of investment. We need to start looking at different actions from investments. One of the pet peeves I have is the term impact investing because it kind of assumes like, oh, there's investment that has impact and then the rest doesn't. And it doesn't actually accept the fact that all investment has impact. It's all doing stuff in the world. And it just may
Well,
be
and
that
it's positive and negative impact as well, right? It's
and
not
it's
just yeah,
uh-huh.
yeah,
And
yeah.
so like you may be like a lot of your investments may be reducing wages, reducing benefits because those companies are rewarded financially in our markets for reducing costs by paying people less or reducing their benefits, right? And so like that's an impact that we're not talking about. And so I think like really looking at the sleeves of the purpose of capital, what are you trying to get your capital to do? Really starting to look at if we do think that there is this crisis around wealth inequality, which all the data points to the fact that we are one of the highest, if not the highest level of wealth inequality in the United States. And historically, when you have those levels of wealth inequality, things go really, really, really bad. That if we want to move in the other direction, we're going to have to be much more thoughtful about the ways we deploy our capital and into things that may not be some like, big steak dinner venture capital deal or some like PE on the private jet deal. It's going to be investing back in the things that built America. Like I love muni bonds. Who says that? But I actually love muni bonds. They actually build things. They build replacing our lead pipes in Chicago. These businesses that we're talking about build things, manufacture things. They have companies that drive around and they'll do your lawn care. They have companies that make the widgets and gaskets that make plumbing fit together. There's like everything in between. And so it's how do we get investors to say, look, I want to create a pipe, like a segment of my portfolio that's focused on building. Maybe it's you're building America or you're investing in America sleeve. And you start to say, well, like, what are the kinds of things that would be in here? And what are the risks in them? And not overcomplicate it and not like pretend that you have some art or science of your previous risk return portfolio. Because, like, to be honest, a lot of the risks that people put in those are kind of made up anyways.
Mm.
That you can look at some of these very tangible, very physical things and create that sleeve. And I would strongly encourage people to do it now because I think that um, the market growth that we have seen, I am less comfortable and confident in the future. And so investing in things that are going to be much more tangible, much more um, resilient in downturns feels like just not just a good for society move, but just a smart move for any investor to be thinking about.
Mhm.
Great.
Yeah.
Thanks.
Well said. And, what I often encourage investors to think about, sort of the first question is, what are the outcomes you want of your investment? What's the impact you want of your investment? And if you're looking at employee ownership in particular, the first comparison is employee ownership versus the mainstream market. So how much do you have in the mainstream market? And wouldn't you much rather have the outcomes of the employee ownership? And then once you get into the employee ownership market, you can think about having a diversified set of investments within the employee ownership market. I think sometimes we get really caught up in like, well, what do we think the potential additional sort of additionality from a positive impact perspective there might be in this employee ownership fund versus that employee ownership fund? But if you start with that first comparison, mainstream market versus employee ownership, right, we know there's a huge difference. And then think about a diversified portfolio as you would like a smart investment strategy. And certainly the strategies across the different funds are going to be different. And that's great because we need to invest in multiple strategies in order to grow this marketplace, right? So, I would get from an investor perspective, I would get less sort of the starting point. It's not necessarily like, oh, what's the form of employee ownership? And so therefore, what does that tell me about the impact? It's what's the overall impact of employee ownership, and then you can look under the hood and get more information and map sort of the potential impact against those three pillars that I talked about previously.
Great. Thank
You
you.
know,
And go ahead. Go ahead,
yeah,
Brian.
so the funny thing is like I was born in 1974, and that's the same year that ERISA was created, which is like the first plan around creating ESOPs and stock plans. And so we have like literally my entire life's worth of data on these kinds of programs and companies and success. And Rutgers has got a great center on employee ownership and worker wealth building that has massive amounts of data. And I just encourage people to like not treat these as exotics. This is nothing like abnormal or different. These are just great bread and butter businesses that now have funds that are returning them back to the people who have built them. And as an investor, you can help make that happen. And that's the call. And I think for anyone who cares about their place, right? So for any university that's sitting on an endowment that says that they're like have a motto that's all about justice, and then they're piling most of their endowment in a bunch of hedge funds that are firing people. How do we get the university endowments to shift towards what would it look like if university endowments put 5% of their endowment towards employee ownership in their community, in their state, in their region? What if the major healthcare systems that have endowments did the same thing in their region, in their state, in their city? What about all the foundations that claim to care about their region? If their endowments, 10% was in building this in their communities, you suddenly have a snowball effect of massive amounts of capital that move towards this that does not take a lot of creative thinking to actually just go do it.
Right. Appreciate that. Um, so let's, I'm looking at a few of the questions and just want to sort of combine them together. You have, I'm looking at the panel, right? And there's a question about language, very specific. The other side is the private equity and venture capital, and this is the hundreds of billions and trillions of dollars that sort of make the world go. And then in the middle is how do you engage mainstream voices? So I know that that's like the entire spectrum, but if you think about a fairly diverse group of people that are participating and interested in learning, um, what are the two or three things that we should all be thinking about doing to actually learn more, to answer the questions about language, to sort of understand where mainstream voices can fit in? Allison, I assume one of your answers is going to be look at the work that you're all doing, and Brian, I assume the same as you with the Delta Fund. But like, just what are some practical takeaways that people here can do to move forward? And I know that there's a panel on this at the Impact PHL Summit next month. So there's certainly that opportunity. But just for the people that are here right now, like what are some tangible next steps that we could all take to sort of have our questions answered?
Yeah, I was going to lift up the Impact PHL conversation as well. And then also we are partnering with a number of folks in the Philadelphia region to host a gathering that's going to be in early October. So it's part of our what we're calling our Employee Ownership Capital Roadmap Roadshow. So we haven't landed the exact date yet, but you can find it on our website. And we would encourage anyone who's local to Philly to come and join us there. I'll stick the link in the chat briefly here. But to your question about voices and mainstream and language, like um, certainly language matters. And Brian was talking about this being something that is very, very bipartisan. Every vote that I have seen on legislation at the federal or state or even local level since I have been in employee ownership has been unanimous, right? So maybe you got some people abstaining or whatever, but the people voting, it's unanimous. There really is, it's one of these things where no matter which angle you look at it from, it benefits, right? So it benefits the selling business owner, it benefits the local economy, it benefits the workers and the workforce, etc. Um, And so certainly people from, different perspectives, especially across the political spectrum, will talk about this work differently. But, at the end of the day, whether you want to be thinking about, some people will align it with the American dream, which we know has not been available to all
Yep.
Americans across our history, right? But um, it really is about things that everyone has in common, right? Wanting to be able to have a job that has dignity, that enables me to support my family in a way that feels good, enables me to show up in a workplace where my perspectives are being respected, that enables us to sort of grow the local prosperity through these business efforts. Like, these are things that we all agree on. And so, I'd actually love to crowdsource the question of who are the hottest voices to speak to the Investing in America opportunity. And I think that's a fantastic question.
Great. Nelson, one last question, then Brian, I'll hand it over to you to close. You mentioned the roadshow. Is that for investors? Is that for financial advisors and consultants? Like, who's the audience you're looking to serve there?
Yes.
Good.
So we are co-hosting these conversations in various places around the country this year, following the release of what we call the Employee Ownership Capital Roadmap that we stewarded the development of over the course of 2025. Because that roadmap represents over 150 voices of people who had direct input into the strategies that it maps out to grow this investment marketplace in meaningful ways. And so we basically are co-designing each of these sessions with our local partners, in order to serve the needs of the conversations that are happening locally. So definitely investors and, investment advisors are critical folks who we want to be in the conversation. And also, the local employee ownership community. Part of what we want to try and do is to bridge across the different stakeholders that can come together to grow this space.
Okay, thanks. Thank you, Allison. Brian, you want to close us out with the 2 minutes we have left? No pressure.
Yes, I was throwing in a link for Transform Finance as I was tapping on my keyboard, which
Great.
hopefully you couldn't hear. Transform Finance is an incredible resource for anyone who wants to download this, like the authoritative document that tells you everything you'd ever want to know about how to think about different forms and formats of employee ownership. You will learn a lot. And they have a list of funds that they're tracking of groups that are raising capital around various forms of ownership. And so though that 1-2 punch would get you pretty far along. And then I do lift up, I think the event's going to be great and the conversations that you can have around the Impact PHL Summit. I know my wife Katie wrote a kind of thought, like an article on kind of some of our thoughts and perspectives around EO with Impact PHL that we really appreciated. And I think that's pretty great. Then I think, look, like you're going to see more things called ownership because people are hungry for it. And by and large, the version of ownership that private equity is selling you is a lie. And so I am highly skeptical of anything that private equity is building in this space. And so the questions to ask when you look at a fund is how are you actually creating ownership? What percent of the company is owned or benefits the employees? How is their governance and what does governance look like for the employees in these deals and situations? And then you can start to understand whether the fund is doing meaningful efforts to that end or if they're just using it as a marketing and motivation tool. Because the research that I've done and we'll be putting out at some point in the near future is pretty clear that the PE guys saw an angle, that people are desperate, they're hungry for success, and they're capitalizing on that to give them a sliver of the outcome. We can do better, and there are funds that are doing way better. And so I'd say read that Transform Finance report, look at the funds that are in their list, and then let's get capital moving.
Great. Brian and Allison, thank you for the conversation and the education. Really appreciate both your times. With that.